Welcome to Module 7, which is all about finance and lending. Finance is a crucial piece in the commercial investing puzzle. Without a thorough understanding of it, or without obtaining advice from a qualified advisor with the appropriate expertise, it will be difficult to expand your portfolio and meet your financial freedom goals. When a residential property is financed, lenders will generally use the contract price, assuming the property was not bought wildly above market. However, in commercial property, a third-party formal in-depth valuation is required. Lenders will normally lend on the lesser of the two between the valuation and purchase price figure. Occasionally, some lenders will use the contract of sale as a valuation as long as certain conditions are met. When thinking about buying commercial property, it's best to think like a lender in terms of your forecasting, strategy, and value-adding possibilities. Lenders constantly change their criteria for lending, but will always look favourably on cash flow positive properties that earn more rent than the loan repayments. Living life creates debt. Owning a property, cars, eating out, and enjoying life costs money. Now, you may have heard people say that debt is bad, but sometimes it can actually be good. A lot of people don't actually understand the difference between good debt and bad debt. So let's look at both of these now. Firstly, bad debt. Bad debt is often linked to things like car loans, credit cards, and home loans against owner-occupied properties. It also includes debt against depreciating liabilities such as mobile phones or laptops. Even though your own home or PPOR may be a good investment, the lender considers them a liability as you're not receiving any return from them. Good debt is debt against a property, investments, collectibles, or assets that appreciate in value and help generate an income. When you're deep in debt, especially bad debt, you may restrict your ability to build wealth. Debt such as car loans or credit cards can significantly impact your borrowing capacity with a lender. This is where a mortgage broker can help you navigate between the various lenders to improve your borrowing capacity. We'll look at mortgage brokers a little bit later. But now, let's look at what options you have when looking to obtain finance. There are typically three options when obtaining finance for a commercial property. 1. You could obtain finance from a lender with whom you've already done business with or have accounts with. 2. You could investigate the mortgage market on your own. 3. You could engage a commercial broker to investigate and navigate the market for you. Additionally, you can obtain loans from banks and loan institutions, money partners, joint ventures, or family members. Let's look at the three main options. Number 1, using an existing lender. Most people who obtain finance from their current lender or bank do so for two reasons. Firstly, they are loyal and trust their existing lender, and secondly, because it's easier. They want to avoid all the paperwork by going somewhere else. This method is only advisable if the lender gives you a competitive rate and terms. If you can find a new lender with better rates, then it's worth reassessing your loyalty, as you may lose thousands of dollars if you stay with your existing lender. For example, on a $1 million warehouse, we have a $700,000 loan. If our current lender offers a 6.5% interest-only repayments, we are looking at $45,500 a year. But say we shop around and find a new lender offering 6% interest-only repayments. Suddenly, we only have to pay $42,000 a year in repayments. Whilst 0.5% may not seem like a lot, just by changing lenders, you have saved $3,500. Over 3 years, that's over 10 grand. Now, do you think it's worth doing some extra paperwork? By using an existing lender and not comparing other lenders in the market, you won't know if you have the best rate available. This is where brokers can help. Brokers will be able to compare rates quickly, and sometimes they'll even suggest that you negotiate a better rate with your existing lender. If you go with your existing lender, you may be capping your borrowing capacity as you'll be subject to that lender's rules and regulations. However, there may be other lenders such as second and third tier lenders with varying rules and calculations that can dramatically change your borrowing capacity, perhaps for the better. Number 2, investigating on your own. Investigating your own finance options is definitely achievable with so much access to lenders' information online, but it is very time-consuming and confusing. You must research each lender's servicing criteria, fees, offers, and conditions. Australia has well over 60 banks and lenders that you would need to investigate individually. If you do decide to proceed directly with a lender, you will need to submit applications, all the necessary documents, and follow the transaction through the entire process. 3. Engaging a mortgage broker. The third option is to use a mortgage broker. This is very popular as they're able to compare multiple lenders and find the most competitive rates and conditions. This requires a lot less time and effort than investigating on your own. Brokers understand the finance landscape in property investing. They literally do this every day for other customers. It is highly recommended that you leverage their knowledge and experience to help you find the loan option that suits you. Let's take a more detailed look at mortgage brokers. A mortgage broker's job is to work through the types of loans, features, and options available for their customers. So, why should you use a mortgage broker? Well, they look at multiple lenders and assess your ability to service the loan, the interest rate, the loan term and fees, principal and interest loans versus interest-only loans, and the use of offset accounts. The broker will help you compare and choose the right loan for you and your future plans. It's not always about getting the best rate, but actually better loan products, such as a redraw facility, better valuations, or more borrowing capacity. A good broker will present these options to you, but ultimately, you as the customer can decide which lender to go with. A big advantage of using a mortgage broker is they will guide you through the whole loan application process. They will also advocate for you if things go wrong with a lender or mortgage application. An important note is, unfortunately, not all mortgage brokers are competent or trustworthy like many industries. Generally, residential brokers aren't proficient in commercial lending and don't have the knowledge or deals to provide you with the best service. A residential mortgage broker may say they can do commercial, but typically they won't be proficient in this because it's not their everyday work. As mentioned before, commercial is a different game with multiple types of loans and potential lenders. So you need someone who has specific commercial experience and understands the nuances of commercial property. The other big benefit of mortgage brokers, they don't charge you. Most people engage a commercial mortgage broker because they do all the work for you and are paid by the lender once the loan is obtained. Don't worry though, reputable mortgage brokers are usually uncompromised, as most lenders will pay the broker a similar amount. With commercial finance, the commission most lenders pay to the broker is directly linked to the establishment fee charged for a commercial loan. So if a lender charges 0.75% of the loan amount as an establishment fee, the broker may get paid around 0.5%, with the bank making 0.25%. If, for a tight deal, the establishment fee is waived, this may mean your broker has to forego their upfront commission or reduce it to win the business. A broker will typically look at more than 20 lenders, which individual investors usually don't have the skills or time to do. Additionally, there are also commercial-only lenders that a general residential broker may not even have access to. As your broker won't get paid unless they obtain a loan for you, in effect, all this upfront work is unpaid. This motivates them to find the best offer for you. Once you have the offer, you can check the websites to see if it's competitive. If you do find a lower interest rate online, please speak with your mortgage broker, as there's usually a reason they chose this loan product for you, such as hidden fees or conditions. Engaging a broker as soon as possible is important because finance can be a lengthy process. It's advised only to use one reputable broker, as it's ethically wrong to ask multiple brokers to perform work, especially when the upfront work is unpaid. Once you find a good broker who aligns with your goals, it's worth being loyal to them to achieve a good outcome and hopefully work on multiple deals. Now that we know more about a commercial mortgage broker, how do you actually find a good one and what questions do you ask them? We previously touched on this in Module 4 where we looked at preparation and building your team. Once you have researched and have a few names, meet with them and ask them the following questions. You can then consider their answers, check their references, and make a choice. The questions for your mortgage broker should include: what are your qualifications? How long have you been a broker? How many commercial loans have you sourced? How many lenders do you have access to? What makes you choose one lender over another? Do you have 2 to 3 recent clients you can provide as a reference? We've included these questions as an accessible download for you to use at any time. A good tip is speaking with their clients in a similar situation to where you want to be. Otherwise, for example, they may send you a mum and dad client who has only bought one property and they think they're great. Try to find someone in a position where you want to be in 10 years' time and ask to speak with them. It can also be beneficial to seek a mortgage broker who has invested in property themselves and has a property portfolio, as it can sometimes be easy to align your strategy and goals with someone who has an investor mindset. Finally, we look at the concept of loan-to-value ratio as it relates to finance. The loan-to-value ratio, or LVR, available from a lender is another factor to consider when choosing which lender to go with. Remember, an LVR represents what percentage of your money is required in relation to the property's purchase price. As commercial loans require a larger deposit due to higher risks associated, typically you'll need a 30% deposit, meaning a 70% loan, or LVR. For example, if you're buying $1 million commercial property on a 70% LVR, you'll be providing $300,000 as a deposit. Remember though, you will also need capital costs for things such as stamp duty, legal fees, building and pest inspections, and valuations. All of that can equate to around 5% of the purchase price. You could find a lender that offers a lower interest rate, but they may only provide a 65% LVR, meaning you would need to provide more deposit. Generally, having a larger LVR will enable you to leverage more and expand your portfolio quickly. So, do you choose the lower rate and lower LVR, or the higher rate and higher LVR? Well, this is where a good mortgage broker will help advise the best loan structure that aligns with your goals and can help you grow into more properties. Well, that's another lesson down, guys. That concludes the topic of finance. See you next one. Welcome back to Module 7, where today's lesson will be looking at the available lenders. There's a large landscape of lenders to choose from when obtaining finance, but they all differ in how they operate. Let's run through the three main types now: major banks, mutuals, and private funders. Major banks. Most people are familiar with the major banks as the most common form of lender. They offer the advantage of a big branch network and are generally owned by shareholders and listed on the stock exchange. Mutuals. Our second type of lender is building societies and credit unions, which fall under the banner of mutuals as they are owned by members, not shareholders. They work the same way as a bank, but the shareholders are the clients or members of the bank. Most of these clients feel a sense of loyalty towards their credit union or building society because they receive more personalized attention and the profits are reinvested for the members. In some cases, mutuals can offer lower interest rates and fees than the major banks. Mutuals offer various financial services such as home loans, personal and car loans, credit cards, savings, and transactional accounts. Although they have a different ownership structure than a conventional bank, they are still authorised by APRA, the Australian Prudential Regulation Authority, so come under the same scrutiny as banks regarding regulations. Private funders. Our third type of lender in the commercial world is private funders or lenders, often a group of wealthy people who pool their money together to lend funds at premium rates. They generally charge higher interest rates and establishment fees as they seek a return on investment. However, they can generally give you more money and have a greater risk appetite. These lenders are more concerned with your security on the loan rather than your ability to service the loan. Private lenders are becoming a fast-growing avenue for developers and investors because the National Consumer Credit Protection Act does not cover these loans. This means it can be quicker and easier to obtain finance as there's less red tape than a bank and no governing body regulates them. Of course, the type of lender you use may also depend on the buying structure that you are using. For example, self-managed super funds or SMSFs can have more limited lending options. Again, this is where a mortgage broker can work to get you the best deal. We will have a look at buying structures later in this module. A less publicised but quite common avenue is vendor finance, also known as seller finance or an instalment sale. With vendor finance, the vendor or seller makes money by on-selling their property to a buyer using a lease option or an instalment contract to provide all or part of the funds. In simple terms, the buyer borrows funds from the seller to buy the property. It's comparable to buying residential properties from developers that offer you the option to buy with little or no deposit. There are such high costs to get into commercial, such as 30% deposit plus purchasing costs. Not everyone has this. Trying to come up with this amount of funding for each investment can halt an investor's portfolio as not everyone has this cash. Instead, with vendor finance, the seller is basically helping you with the deposit. This is a clever way to buy a property at a higher price than what you can actually afford. When vendor finance is being used, the vendor needs to own the property they're selling unencumbered, which means outright, or at least have a debt level low enough to pay it off from your LVR or their resources. The buyer and seller need to agree to the terms of vendor finance, and the seller needs to trust that the new buyer will pay them back. I suggest talking directly to the owner or vendor and not liaise through the real estate agent, as you'll get to explore more opportunities. The new buyer will usually make monthly principal and interest repayments to the seller. The title will either be transferred immediately or once the final repayment is paid to the seller, depending on the vendor finance type. There are 3 common forms of vendor finance. Let's have a look at them now. Number 1, terms finance and installment sale. With this method, the property's value is repaid in installments and the title remains with the vendor until either the final installment is paid or the buyer refinances the loan with the bank and the title is then transferred. The duration of the contract can be as long as required, but normally a purchaser pays it out as soon as they can refinance, which is usually within 2 to 5 years. Number 2, mortgage-backed finance. With this type, the vendor loan is used as the deposit for finance. The deposit is funded by the vendor using an external party. The vendor funds the difference between the price and the external finance and takes security for payment through a second mortgage over the property. The title will be transferred to the buyer right away. Number 3, lease option finance. In this third option, the property is leased to the purchaser who makes additional payments to the deposit on the purchase. This method works well if the buyer is an investor or business owner who wants to operate out of the premises but does not have the required deposit. Generally, the title is transferred right away. In vendor finance, there's typically a specific date set for the final payment, known as the balloon payment. This payment can be made in cash or by refinancing the property. As an investor, it is crucial to avoid setting the balloon payment date too early because it could lead to foreclosure or property loss if you don't have the funds available in time. So, as an investor or buyer, why would you consider using vendor finance? 3 main reasons are minimal savings. If you're unable to provide the required deposit, normally around 35% for the property, but are able to service the loan. Short or poor credit history. If you have a poor credit rating or a short credit history, it may be hard to qualify for a loan with a lender. Self-employment. If you're the owner of a business that has been operating for fewer than 2 years, or you haven't demonstrated financial discipline or saving, banks may be reluctant to lend to you. On the other hand, you can also sell a property using vendor finance. A seller may consider vendor financing if they are more interested in getting the highest price for the property rather than getting the cash at the time of the sale, have a sense of security and trust in the property's long-term prospects. If the new buyer fails to repay as specified, they are willing to retake possession of the property. They don't need all the cash from the sale immediately and are happy to have a solid return. Can reduce their capital gains tax obligations by not cashing out all of the property at once. Vendor financing allows for them to spread the gains across multiple years and also reduce their tax. They are desperate for the sale and therefore more open to non-conservative offers. Or they are personally attached to the property and want to ensure it goes to the right owner long term. Of course, vendor financing also comes with risks for the buyer, which may outweigh the potential benefits. Some risks include, if the property depreciates in value over time, the bank may not lend you the money to refinance. The purchase price and subsequent repayments are normally higher than market value, which will make it harder for you to build equity and to qualify for a loan when you need to refinance. As your name may not be on the title, your ownership is at risk. For example, if the vendor goes bankrupt, others may make claims against the property. The laws regulating vendor finance are extremely cloudy, so the buyer can often be at the seller's mercy. Sellers can be far more painful than dealing with a bank. For instance, if you don't meet their payment even once, theoretically they could sue you or keep the deposit. The risks to the seller are relatively minimal as they will usually own the property until the vendor finance is repaid. They only risk losing the money provided to the buyer, and this is usually mitigated by having adequate security from them. If you're considering vendor finance as an investor, it is crucial to seek advice from a solicitor to make sure your interests are protected before you enter in any agreements. Now that we all know the different types of lenders available to us, next lesson we'll look at the different loan types. Thanks for watching, guys. See you next lesson. Welcome back to Module 7. So now that we know the various lenders we have available, let's look at the different types of loans. How you structure finance on your commercial property is one of the most important parts of your investing strategy. So many loan products are available nowadays, but it's important to note that commercial and residential property loans are different. Residential loans are usually principal and interest, or interest only for a short period and are over 20 to 30 years. Commercial loans will have more variety and will be usually the length of the lease or 10 to 20 years. For multi-tenanted properties, such as shopping centres, lenders will typically take 75% of the WALE of the loan term. Remember, WALE stands for Weighted Average Lease Expiry. For example, the lenders would give you a 3-year loan if you had a 4-year WALE. At the end of the 3 years, you'll have to complete another application, which will incur more bank fees, so it is best to have as long a WALE as possible. With any commercial loan, the fees can vary wildly, so it is important to check these and discuss these with your broker if you have one before you proceed. In many cases, a low interest rate may look better, but may not be cheaper overall than the higher rate with lower fees. Any good investor should also spend time stress testing the new deal as well as their current portfolio. Many lenders apply a 2.5% increase on presented interest rates, so this is a good place to start. Particularly in our current economy, it is essential to have buffers in place for increasing interest rates. Remember, you can do this by using the stress test calculator we introduced back in Module 3 to understand how interest rate rises would affect your cash flow. Before we look at the different loan types, let's revisit the differences between a fixed and variable interest rate and principal and interest versus interest-only loans. On most loan types, lenders may offer loans with a fixed interest rate or variable rate. A fixed rate enables you to lock in your interest rate and corresponding loan repayments for a set period of time, usually 1 to 5 years. Regardless of changes to the official cash rate, your rate is locked in. Generally, a fixed loan will be higher than a variable rate at the time, but if interest rates rise, you'll be financially better off. If we look back, those who locked in their interest rates during 2021 or early 2022, when the cash rate was the lowest ever, are much better off now than those who did not. As we have seen, the cash rate increased dramatically during the end of 2022 and into 2023. When the fixed term ends, the interest rate reverts back to the variable rate. Of course, this can also have the reverse effect, which we saw at the end of 2019 and into 2020 when the cash rate decreased. So anybody locked in with a fixed rate was paying higher rates. The benefits of a fixed rate are that it provides certainty and allows you to budget. However, this can also impact any refinance or if you need to sell the property, as paying out the fixed rate early, there may be financial penalties from the lender. A variable rate, on the other hand, is the most flexible and involves an interest rate that fluctuates over time. A variable interest rate is based on the official cash rate. These loans generally allow you to make extra repayments, have offset accounts, and also redraw the repayments. However, if interest rates go up, you may be in a worse position than if you had a fixed rate. Split terms is a third option where you separate your loan balance into two, one with variable rate and one with a fixed. As mentioned before, there are advantages to both fixed and variable rates, and with a split loan, you can get the most out of the features and benefits of each. The fixed component allows you to manage the risk of interest rate fluctuations in times of economic uncertainty. At the same time, you can take advantages of the rate cuts with the variable component and have other features like an offset account or extra repayments. You can allocate as much as you want to each account as long as it's allowed by the lender. Principal and interest versus interest-only loans. Principal and interest loans involve gradually reducing the money you owe by paying off a portion of the principal each month. The repayments are higher than an equivalent interest-only loan, however, generally we receive a lower interest rate in comparison. Interest-only loans involve paying off the interest or the cost charged by the lender for the borrowed money. These are very popular with commercial property investors, especially during the accumulation phase, as they're more tax effective and will increase your cash flow due to lower repayments. While interest-only repayments are lower during the first period, you'll end up paying more in interest over the life of the loan unless it's refinanced. The loan term is generally 3 to 5 years, after which the repayments will convert to principal and interest. When deciding which option is best for you, you must weigh up where you're at with your investment journey, your risk profile, and your overall goals. Okay, now we have looked at those points, let's have a look at the different types of commercial loans. There are several different types of commercial loans, including full documentation, no documentation, lease documentation, lines of credit, and split loans. Refinancing and using commercial bills are other options. Plus vendor finance, which we touched on last lesson. Let's look at each of these in more detail now. The full documentation, or full doc, is the most common type of mortgage issued by Australian lenders and is similar to residential. This loan application requires the most information, including details of your income, assets, outgoings, and debts. Next, we have no documentation or low documentation loans. If you're self-employed, a contractor, or even a professional investor, it's usually more difficult to provide all the financial documents to satisfy the lender's requirements. No doc or low doc loans require less information about your assets and liabilities and have more relaxed rules than the full doc loan. The lender will mitigate their risk by requiring a larger deposit, usually a minimum of 30%, and providing a higher interest rate. These loans are really popular during 2008 and 2009 financial crisis, but are less common now. The loans are generally for a short term of 6 months to 3 years, and then the interest rates will increase. Lease documentation or lease doc loans are excellent for investors with several properties and have run into serviceability issues with traditional lending. For a lease doc loan, lenders solely look at the asset and the tenants involved to determine a borrowing amount based on the property's net income. They don't look at you that much personally, so you don't have to go through the rigmarole of the bank's examining expenses, like what you spend on Netflix each month. Simply put, the lender will give you a loan based on the property itself. Generally, these loans do have a lower LVR though, around 50 to 65%, so you'll need a much larger deposit. The bank will normally want to see an extra buffer in their calculations just in case interest rates go up. Let's have a look at some of the figures. So for our $1 million property, we may aim to get a 65% loan for $650,000. Our repayments at 6% interest rate would be $39,000 a year. We are getting a 6% net yield, so $60,000 in rent yearly. So the bank knows that the rent from the property can service the debt, and there's a $21,000 surplus in case interest rates rise. The difference with commercial property is that you can normally find finance to fund the purchase as long as you have a big deposit. You could be out of work, working part-time, working as a casual, or totally tapped out with serviceability in residential and still continue to buy commercial. Sounds pretty good to me. This is because the bank is not looking at you. They are looking at how much the rent on the property can service the debt. The loan term is usually in line with the remaining lease term. So if the property has a 5-year lease, you'll get a 5-year loan. Plus, the loans are generally always interest only. So who is this loan best suited for? Lease doc loans can be very useful for people with an extensive property portfolio who wouldn't be able to get full doc loans, retired people who may have cash but are not working, and people in a syndicate with a complex corporate tree who cannot trace their flow of money. Most lease doc loans are used for new acquisitions, so the lender knows that the buyer isn't relying on that income to cover other debts. So what happens if the tenant leaves? This is the biggest question people often ask me. Well, obviously you need to service the loan and costs whilst finding a new tenant, and the bank will normally make you pay a slightly higher interest rate until you get a new tenant in. Once a new lease is signed, however, you can apply for a new lease doc loan. Of course, some costs will be involved, such as administration and the valuation, so keep that in mind. Our next option is the line of credit, which allows you to use equity from your principal place of residence or investment properties, which could be residential or commercial. It is an agreement between you and your bank that gives you access to a predetermined amount of credit whenever you need it. The money you borrow is usually secured against your equity in that property. It functions in a similar way to a credit card. You have a pre-approved credit limit and you can borrow as much of this as you want, paying interest on the outstanding balance. If you use another property as security for a line of credit, it makes you less risky for the lender, so you may pay a lower interest rate compared to other types of debts. However, since one of your properties is being used as equity for the line of credit, there's risks involved. If your investment value decreases or you fail to make repayments, you could end up losing both properties. It's important to note that a line of credit is not amortized, which means that your regular payments don't decrease the debt or pay it off entirely. It doesn't work like a loan that you pay off over time. Next, we have refinancing, which isn't exactly a loan, but it is securing a new mortgage by revaluing a property. A myth in investing is that you cannot refinance a commercial property, but this is completely false. Refinancing may help you reduce monthly payments, lower interest rates, or change lenders. Often by having your property revalued and then refinancing, you can free up some equity to invest further. One note here is that valuations do cost quite a lot of money, so you don't want to be doing it every year. It is best to wait until you have some really good capital growth or the tenant has just signed a new lease, so you get a strong valuation. Lastly, we have a commercial bill, a promise made by a client to pay the bank a specified amount or the face value of the bill on a specified future date or the maturity date. Sophisticated investors use commercial bills, which can be an excellent solution for more than $100,000. Normal terms are from 1 to 6 months for variable rates and 1 to 5 years for fixed rates. The interest rate, or known as the floor rate, is based on the bank bill swap rate, BBSW, and a margin called the facility fee of 1 to 3%, which the lender adds. This margin can vary significantly amongst lenders, depending on factors that include the financial strength of the borrower, the underlying security, and competitive pressures. As you can see, there are several different loan types that can be used for commercial property. It's hard to know exactly what property is right for you without knowing how much you can borrow and what type of loan you are applying for. Finance can make or break your deal, so ensure your ducks are in a row before purchasing. This is where an experienced mortgage broker can work with you to provide the best loan type for your goals and overall investment plan. Thanks for watching, guys. See you next lesson. Welcome to the next step of finance and lending, where we'll look at the loan process. A big difference in finance and lending for commercial properties is pre-approvals. Brokers and lenders cannot give you a definitive pre-approval because commercial properties vary considerably with different uses, yields, conditions, and overall risk. Finance is very property specific, as lenders will want to consider the property, its location, the tenant, the rental return, whereas with residential property, this is less of an issue. In commercial, lenders can provide a pre-approval in principle based on some assumptions, but this is not a formal pre-approval. Once you have found a property and the contract of the sale has been signed, it's sent to the broker or lender so they can begin processing the loan. Finance approval is typically the longest and the most stressful part of the property purchase, and sometimes extensions of time are needed. Unfortunately, lenders often respond slowly, give poor valuations, and require you to submit many documents, mostly in hard copy. Commercial property valuation can be unpredictable due to the difficulty in finding comparable properties. The larger your portfolio, the more complicated lending and valuation procedure becomes. If the contract is subject to a finance clause, you'll be trying to obtain finance before the purchase becomes unconditional. Your mortgage broker and lender must have all the information they need at the very start of the process, including proof of personal information and financial history. As discussed earlier in the course, it is critical to engage with a mortgage broker with experience in getting finance for commercial deals across the line, not just residential. So let's have a look at what information you may need to provide to the lender. Of course, this does depend on what type of loan you're going with. Your personal information. If you're borrowing from a lender for the first time, you may need to provide proof of identification. They may require you to present your passport, driver's license, birth certificate, and government identification cards such as Medicare. The lender normally also requires information about the length of time you have been at your current address. Additionally, they will want to confirm information about your number and age of dependents, children or otherwise, and your relationship status. Next, lenders will also be looking at your financial situation. When evaluating a loan application, lenders will look at your banking history. Ideally, you will have had stable and regular income and expenses for at least 2 years to maximize the strength of your application. You should be trying to avoid any unpaid debts, bankruptcies, and legal monetary matters that would affect your capacity to service a new loan. You'll need to supply detailed information about your finances, which may include the details of your assets, including proof of your savings history, your bank accounts, current properties, and any other investments such as shares, your living expenses and outgoings, your credit cards, store and charge cards, including statements, any history of defaults or arrears, proof of employment, proof of income and government payments, bank statements showing income up to 6 months back, and group certificates, tax returns, tax assessment notices, and balance sheets for the most recent financial year. As a final option, if you're having difficulty securing finance for a commercial property and you have one of the conditions such as subject to finance, you may request an extension of the finance period. Agents and sellers understand the harsh lending environment, especially for commercial, and will usually agree to a valid request to extend. The main point is to only go unconditional on a property once you have unconditional finance. If you default on a contract because finance is unavailable, the vendor may force you to forfeit your entire deposit and sue you for any damages. Obtaining finance for an unoccupied or vacant property can be more challenging as you need to prove that you can achieve a certain rent for the space. Lenders will typically focus on the property's potential cash flow and may favour a tenanted property with a strong lease and a long remaining term. Given this, if the tenant has less than 1 year left on the lease, it's worth asking if they would exercise the renewal option now, as this will help you get finance over the line with the lender. As discussed in our lesson on leases, you may need to offer incentives such as halting rental increases for the term or reducing the rent to get your tenants to sign a new lease. If you have other properties and you're using equity from them as a deposit, you need to assess which properties it would be best to leverage and compare the interest rate differences. Because commercial property loans are typically a high interest rate, leveraging a principal place of residence or residential property can save you quite a lot in interest repayments. The lender will also value the property nominated as security unless a line of credit is used. So, what do the lenders actually look for when giving you finance for a property? The 5 C's of credit. The 5 C's of credit is a rule of thumb that most lenders will look at, particularly on full documentation loans. These are character, capacity, capital, collateral, and conditions. First, character. Lenders want to know who you are. They want to ensure that the borrowers have honesty and integrity, as this demonstrates a willingness to pay back the mortgage. The lender needs to be confident you have the background, education, and stability of employment to do this, and will also verify whether you have a criminal record. Banks sometimes give better rates or higher LVRs to people in certain professions. Usually this is white-collar or government jobs such as doctors, nurses, police officers. These jobs are deemed as stable with a lower risk of unemployment. If you're applying for a loan with another party, the lender will examine the personal credit of all borrowers and/or guarantors involved. Lenders will be looking to confirm that your past financial information is consistent and free of delinquencies, so be prepared to explain any past credit issues such as missed loan repayments. Next is capacity. This refers to serviceability and your ability to repay a loan. Lenders assess your capacity on some factors including your income, loan amount, your age, your expenses, and other commitments. The bank takes these factors and calculates a debt service ratio, or DSR, which is the percentage of your monthly income expected to be spent on debts. When considering your income, the lender will also consider things such as overtime, commissions, or bonuses and company cars, although sometimes banks will only take a portion of these. If you have a second job, each lender will have their own criteria to determine how much of this income will be counted. A portion of your rental income from investment properties may also be considered, as well as the strength of the lease, location, and vacancy rates. Lenders will take, say, 80% of the rental income you get, which allows a buffer for vacancy periods. This is called shading the property and will affect serviceability. The good thing about commercial properties is that even with the shading criteria, they are still high cash flow positive properties and you can keep moving forward with your serviceability. Lenders will also calculate your repayments by adding a margin interest rate percentage, usually around 2.5% or more, to the variable rate. This new higher assessment rate is used to predict whether you'd be able to meet the repayments if there were an interest rate rise. APRA sets the minimum assessment rate, but banks and lenders choose their own buffer rate. Outgoings, including regular expenses, credit card debts, car loans, student loans, and number of dependents may also impact loan serviceability. To improve the chances of obtaining a loan, it is important to minimize credit card limits and make timely repayments on personal and car loans. Capital refers to the borrower's wealth and any assets or valuables that comprise their total net worth. In short, it's the value of your assets minus your liabilities. The lender will consider your savings, investment properties, shares, car, and other assets minus your debts, including personal loans or credit cards. Lenders want to see that you have a buffer that will allow you to keep paying your loan if you had a financial setback such as losing your job. The fourth C is collateral. Collateral is represented by the properties or assets used to secure the loan. If a borrower cannot make their agreed loan repayments and you have cross-collateralized the property, the banks have the right to seize the collateral and to repay the debt. Don't worry though, lenders won't just take your property if you miss one payment. They want to work with you and will typically explore other options before resorting to this measure, such as reducing or freezing repayments for a period. If the lender does sell the collateral, the borrower retains any capital gains from the sale. If you cannot provide collateral in the form of property, some lenders offer guarantor loans, which use a third party's collateral as a backup. Finally, conditions. This refers to the financial conditions when you submit your application, specifically your interest rate, principal amount, and general market conditions. It encompasses any outside circumstances that may affect your financial situation and ability to make loan repayments. Lenders may evaluate the overall business climate within your industry and associated industries, and the economic conditions that could affect your borrowing, including the Reserve Bank's cash rate and any policy changes. These factors can also affect the lender's allowable LVR for the property. The final step we will look at in the loan process is to receive a valuation for the property. Where residential property is usually a desktop valuation performed free of charge, commercial property valuations are more extensive and usually cost between $800 and $3,000 for a standard property. Once a property has become conditional, lenders will usually give you the names of 3 valuation companies on their panel. Your mortgage broker will liaise with you and provide these options. It is best to call each valuer to see how knowledgeable they are and to confirm their costs, which can vary wildly. A good tip is speaking with the agents about recent sales, as these may not show up immediately on databases. Coincidentally, the cheapest valuations often are the most strict, giving a short valuation, whereas the more expensive one give a more accurate and on-point valuation. So again, it's not always worth just going with the cheapest valuer. If recent sales work in your favour, then letting the valuer know about them is a good idea. If you can provide useful information to them, you may get a better result. Once you select the valuer, you will organise to pay them and they will proceed with the valuation. As mentioned earlier, you don't want to be performing a valuation on an existing property unless it's worth it. Instead, give the valuer a call and ask them what cap rate they are applying to similar properties, as this will give you a good indication of the valuation you'll obtain and whether it's worth spending the money to refinance or extract equity. Once you've engaged the valuer, they will inspect the property before writing the report. Valuations go into a lot of detail. We're talking 50 to 60 pages, similar to the amount of due diligence you should have performed yourself. The report will include a lot of information, including a synopsis of the property, site description, photos, SWOT analysis, and more. When purchasing a commercial property at auction, lenders typically use the purchase price as the property's value because it was established through fair market competition. It is important to get this valuation done before going to auction, as you don't want to buy something and then be unable to obtain finance. So, what happens if the valuation comes in low or under what you're expecting? First, don't stress. Under market valuations are common in commercial property, as some valuers are very cautious. You have a few options if the valuation does not come back as you expected. You can renegotiate the purchase price, contest the valuation, look for another valuer, or leave the deal completely. If you renegotiate the property price because of a poor valuation, you must carefully analyse why the banks valued it lower than you expected. One option is you can also pay the difference from your own pocket to get the deal done if you think it's a good, solid property. The most important thing is don't be afraid to walk away from a deal. As I've said before, the costs you've spent on this deal up to this point are insignificant compared to having a property that doesn't suit your needs or sets back your property journey. Once the valuation is accepted, your bank or lender should then give you unconditional approval, which means you can satisfy the finance condition on the contract. It is recommended to go unconditional on the contract only after due diligence and building and post inspections are complete. And that brings us to the end of another lesson on finance and lending. Thanks for watching, guys. See you next lesson.